You've seen it on your bank statements, maybe heard it in a branch, or even clicked on it in your online banking portal. Those two letters, seemingly innocuous, yet carrying a weight of financial implication. They're everywhere in the banking world, a quiet constant, but have you ever stopped to wonder what they actually mean? What lies beneath the surface of that common abbreviation? We're not talking about just any random acronym here. This isn't some obscure industry jargon designed to confuse the average person. This is fundamental. It's about how your money moves, how it's held, and ultimately, how your relationship with your bank is structured. If you've ever felt a slight disconnect, a subtle mystery surrounding certain banking terms, you are not alone. The financial world, while essential to our lives, often speaks in a language of its own, full of shorthand and specific terminology. And today, we're going to demystify one of the most prevalent. Think about it. You deposit money, you withdraw money, you transfer money. But where does it all reside in the interim? How does the bank categorize your funds? Is it simply a big, nebulous pool of cash? Not quite. Every transaction, every account, every single penny you entrust to a financial institution is meticulously categorized and accounted for. This isn't just for the bank's benefit, it's for your security, for regulatory compliance, and for the entire system to function smoothly. And at the heart of much of this categorization, especially when it comes to your everyday funds, lies our mystery abbreviation. It's a term that signifies a specific type of account, a particular way your money is held, and it directly impacts your accessibility to those funds. It's the bedrock of liquidity for both you and the bank. Without this fundamental concept, the very notion of a checking or savings account as we know it would cease to exist. Imagine a world where your deposited cash isn't immediately available, or where your bank doesn't have a clear, immediate understanding of its current obligations to its customers. Chaos, right? This seemingly small detail is one of the pillars upon which modern banking stands. It's about immediate access, it's about the everyday flow of commerce, and it's about the trust you place in your financial institution. So, let's pull back the curtain. The two letters, TD, when you see them in the context of banking, stand for time deposit. Now, you might be thinking, time deposit? But I can access my money whenever I want. And that's where the nuance comes in. While the most common association with time deposit is often a certificate of deposit, CD, which truly locks your money away for a specific period, the broader definition of time deposit encompasses any deposit that is not payable on demand. However, in the everyday banking vernacular, especially when you see it on statements or as a general category, TD is almost universally used to refer to time deposit, differentiating it from demand deposits. Demand deposits are what you typically think of as your checking account, funds that are payable immediately upon your request. Time deposits, while they can include those long-term CDs, also conceptually cover savings accounts where, technically, the bank could require a notice period before withdrawal, even if they rarely enforce it for standard savings. It's a subtle but important distinction that underpins the liquidity management of financial institutions. It's about the theoretical framework of how your money is held and its accessibility. With that said, thanks for watching and until next time.